Recent data suggests that an average U.S. adult lost over $1,800 due to financial errors in 2022. How can you avoid that? Keep more of your hard-earned money in your pocket. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I don't know if it's clickbait or not, but it got me. And it got Kevin Korhorn as well, founder of our firm and one of my co-hosts on the talk show that we have that airs right here on this channel, 10 a.m. every Saturday morning. And so it talked about how financial illiteracy is an epidemic. It's far and wide-reaching. It's at a crisis level. And guys, I will tell you that 8 years ago, this is what led us to start the Wise Money Show, our financial education efforts through our financial planners at KFG, where we are helping to explain different financial concepts and the wise approach that you should take to solving them and figuring out how to make financial decisions, looking at all 6 areas of your financial life. The goal, raise the financial literacy for our community and those that would follow and listen. And so, yeah, we're aware that the financial world is way too complicated. It's getting more complicated. And if you're not able to keep up, if you're not astute, you could be making mistakes or lost or left behind. This data suggests I have no idea how they quantified this. No idea, and I didn't even go deeper into the rabbit hole to try to see, but they're saying the average U.S. adult last year, due to unforced financial errors, cost them over $1,800. That's way too much, way too much. So what are 3 ways that you can increase your financial literacy, or 3 ways to avoid costly financial mistakes that could ultimately cost you a lot of money? What are those 3? I've got them right now. The first financial mistake to avoid is unnecessary overdraft fees, interest rate charges, other charges like that. Being late on an electric bill, they're going to charge you for that. So if you're not doing a monthly budget, if you're not managing your cash flow, and did I pay this bill on time, or I don't think I even got this bill, did they switch it to paperless delivery, which happened to me. I did not elect it. My electric bill company just started emailing me the bill every single month. I wasn't getting it in the mail. What if you missed that? So those types of charges, they add up. They add up. What about not doing your monthly budget, having a handle on what you're spending, and still paying for subscriptions that you're no longer using, right? I think we're all sort of prone to do that, or it's very possible. So not having a handle on your overall budget and your cash flow, that's going to cause more errors, more fees, overdraft fees as well. If you aren't operating with a 3 bank account system where you've got what's called a float in your checking account, that means, as I get paid, the balance increases. As I spend, as I divert some of this money to saving, it goes down, but we're never anywhere close to being overdrafted. And then it goes back up when I get paid again and back down. And then you've got a mechanism for if, when non-monthly expenses come up, you know how you're going to pay for those and handle those. You've saved up for those. And then how emergencies, if you're not operating that system, it's going to cause more fees, overdraft fees, more expenses. That's one unforced error that can improve your financial literacy and make sure that you're not having unforced errors that are costly in your financial life. The second unforced error that I would want you to make sure you're capturing, don't miss 401k match dollars. Don't miss, and again, I don't know how they calculated this $1,800 of cost that the average U.S. adult faced last year. But if you're not getting your full company match, that is an unforced error, a costly unforced error. Here's how that happens. One, the logical is, well, I'm contributing. I thought my company gave a match on 5%. They actually give it on 8%, and I'm just doing 5%. I missed out. Or I am not able to contribute, or they give a match on 5%, but I'm only able to contribute 3%. Okay, that's one way that you're just not contributing enough. Okay, the other that we see even more. So you've got to look and double check, how much is the company match? Am I doing everything to get the full match? You've got to make sure, just don't leave money on the table. Make sure that you adapt your budget and adjust your finances to at least get the full company match. But the other one that we see more often is you've got a married couple where one individual is the primary breadwinner and they're contributing enough to get the match, but the other individual is not contributing at all because they're only working part-time, or they're not doing enough to get the full match because they weren't, they're part-time, they're not really doing it, it's just pocket change and not really thinking about retirement. You're giving up match dollars. You're giving up match dollars. That should be calculated and part of this financial cost from errors last year. Don't have this error in your life. Do what you need to do, contribute what you need to do to get the full company match. Beyond that, work with a certified financial planner, find out how much you need to be saving to reach your retirement goals, and make sure you're saving at that level, which I'm confident will make sure that you get the full company match. So avoid that second unforced error, missing out on some company match. And then finally, and I'm certain this was not calculated in this survey, in this analysis, as part of the calculation for financial mistakes or costly financial mistakes, but I know it's real and I know it's significant, and that is missing out on tax benefits, missing out on some tax advantages. I've got a list, okay, that I think people miss out on all the time. Just saw this one this week where individual is working, they've got a lot of kids. They have, more than 3 kids, okay? And they make a decent amount of money. You're gonna need to if you've got that many kids, but the child tax credits are such that it wipes out all of their income taxes. They pay no tax. Wouldn't we all want to be in that situation? Yeah, but the kids cost money too. But they were saving in their 401k, pre-tax. They were saving pre-tax into their 401k, even though they were paying 0 taxes, 0% tax bracket, they were still saving pre-tax in their 401k. That's an unforced error. That's an unforced error because way out there in the future when they retire, they're not going to have those kids as dependents. Oh my goodness, they better not, right? They're not going to have those kids as dependents. So odds are they're at least going to be in the 10% tax bracket, more likely the 12% or 22% tax bracket. But they're avoiding paying 0 tax today, even though they should be contributing Roth, and yes, Roth is available within their plan so that they never have to pay tax on those dollars again. Unforced error. What about missing out on retirement savers credit, where one individual is contributing more than $2,000 to their 401k, and they're eligible for the retirement savers credit, so they get the credit on their $2,000, but their spouse didn't contribute anything, and they're missing out on the tax credit there. Well, instead of one person contributing more than $2,000, what if they contributed the $2,000 and made sure their spouse contributed the $2,000? You maximize that tax credit. What about having medical expenses but not putting them in your HSA first to get those tax benefits? What about having college expenses but not running them through your 529 first to get state tax benefits or tax deferred growth? There's a lot of that. I think that happens, and I have no idea how to quantify it, but it's got to be, it's a lot of money that is missed, tax benefits that's missed by not being proactive with your tax situation. So that's an astounding number, $1,800 per U.S. adult of financial mistakes, costly mistakes last year. I don't know how they came up with those numbers. Those 3 are areas that I'd encourage you to focus on to raise your financial literacy and make sure that you don't have unnecessary financial waste or costs, or you're missing out on some financial benefits. Avoid unnecessary overdraft fees, those sorts of things, by having a monthly budget and a 3 bank account system. Make sure that you're getting the full company match, you and your spouse, and make sure you're contributing enough to be on track with your retirement goals, and do proactive tax planning so you're not missing out on obvious and clear and otherwise at your fingertips tax savings that you're not taking advantage of. Make sure you're taking advantage of those. Work with your certified financial planner. They're going to help you with all of those things, as well as that creativity, finding other ways to enhance your overall financial situation, get you closer to your goals on a faster track or a straighter path to get there. Work with your CFP. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.